My name is Andrew Dix. I'm the publisher of Crowdfund Insider, and this is another session of our ongoing webinar series where we talk about online capital formation and securities crowdfunding. And today we have another awesome topic to discuss: alternative investments in crowdfunding and the emergence of other securities types offerings beyond debt and equity. And once again, I have a group of experts that are willing to share their wisdom and experience in the space. And I'm going to ask each of my panelists to introduce themselves and to share a little bit about the company or companies that they're running right now. And I'm going to start with you, Mohit, just above me.
All right. Well, thank you so much, Andrew, for having me. Love being with you guys, and literally looking forward to hearing what the others have to say here, Avi, and of course Eitan. I'm just a boring dude, but I'll tell you a little bit about myself and what I'm doing. So I run a capital raise platform called Equidify. Equidify is just came out of stealth maybe about a year ago. Prior to that, and in concert with Equidify, I run a SEC registered transfer agent called Equity Stock Transfer, which was born in 2011. And Equidify currently does a Reg D offerings and Reg A plus offerings, Reg S offerings, and self-directed offerings. We do not do Reg CF offerings. And Equity Stock Transfer as a transfer agent that manages the cap stack and record keeping for several alts, a couple of alt issuers and various other private and public company issuers that came out of either equity crowdfunded raises or just in traditional IPOs or private companies. So we manage nearly 1 million shareholders on our Equity Stock Transfer platform.
Awesome. Thank you very much, Mohit. Eitan.
You're very welcome.
Andrew, great to be here with you again, and Mohit and Abi, great to be here with you guys too. My name is Eitan Butler. I'm the chairman at Dalmore Group. Dalmore is a FINRA registered broker-dealer, and also Dalmore Technology is a technology company that specializes in capital raise technology. Dalmore has onboarded over 1,000 private companies. We got started in 2005. Our main focus is really on the strategy and execution, as far as helping founders identify which is the appropriate exemption to consider, path to consider to satisfy their capital raising objectives, whether that's equity or debt, whether it's a startup or a more mature company. Our focus is really laser focused on how to leverage these exemptions, what the appropriate strategy, marketing, that goes into this, kind of leveraging our experience having been the broker-dealer on over 1 million Reg A investments. I think we have a pretty unique perspective, and we're always looking to get smarter and share that knowledge and experience with our clients.
Great. Thank you very much, Eitan. Abi, it's good to see you again.
Great to be here, and thanks again for having us, Andrew. It's a pleasure. As a quick introduction, my name is Abi. I'm a director here at Republic. For those that are not familiar or are unsure about what Republic does, but we're a financial technology company that specializes in investment-related services in private markets. So, this includes both a retail investment division, focuses on like equity crowdfunding, as well as a global marketplace, a blockchain advisory service, and a private capital division. Since inception, we've deployed roughly about 2.6 billion in investments, roughly on a global scale, about 2,000 ventures, and have since really transformed the business, not only from just a marketplace, but to provide other services, within the alt space and other industries as a whole. So super excited to be here and talk a little bit more about what we're doing in the space.
Awesome. Hey, Abi, does the 2.6 billion, is that inclusive of seeders or is that separate from seeders? I'm just curious.
It's inclusive of seeders, as well as components of our traditional venture capital division.
Okay, awesome. All right, great. All right, so today we're talking about alternative assets in crowdfunding, securities crowdfunding. And it's my opinion that when the Jobs Act of 2012 was signed into law, the authors of that legislation really weren't thinking about the ecosystem that has evolved today for alternative assets. They were really thinking about early stage. It was private securities offerings to support entrepreneurs pursuing startups at different stages. And I think also maybe there's some there's a thought there that maybe the real estate guys would leverage it as well. But I think that honestly, they had no idea of the ecosystem that would evolve over time. So we've gone from early stage, mid stage investing into early stage firms, private firms, to today we have this whole new world of crazy types of assets that beforehand it was really difficult to participate in. You can participate in supporting athletes. You can do cars and racehorses, collectibles, alcohol. There's all sorts of different types of offerings available today. And later on in our discussion, I'm going to ask each of you guys to talk about specific offerings that you're enabling and facilitating. So we're not quite there yet, but I wanted to ask each of you, why somebody would consider participating in an alternative investment. I mean, what's the interest there? Is it a non-correlated return? I mean, and I'm going to start with you, Mohit. What are your thoughts on that?
Yeah, absolutely. And that's a great question, Andrew. So, take, for instance, one of our clients, which is Masterworks. Masterworks, provides for the fractionalization of fine art. So to the extent that, your average Main Street investor, is not able to be able to purchase a Renoir or a Picasso, the idea of being able to purchase a fractionalized alternative asset is quite remarkable. It's not something that we would have seen 15, 20 years ago, but now, given the sort of playbook that the Jobs Act has created for alts, and as Eitan mentioned, that wasn't originally supposed to be that way, but now we have these sorts of alternative assets being able to be fractionalized. It gives an opportunity to some of these investors to be able to participate in being able to purchase these assets for net gains. And I think that was something. It's a type of democratization that's occurred in the alternative asset industry, and we've seen that growth firsthand, of course, and working with Masterworks. We're currently conducting 40 to 60 closings a week. So we're seeing fresh blood, new investors come in. We see investors that are already in the ecosystem double dipping, triple dipping into these alternative assets and making money and profits off of redemptions that are done when these assets are sold. So we see that there. Of course, as you mentioned, Andrew, you see it in the real estate industry. We're also working with another company that is going to be securitizing a biotech intellectual property, packaging it, and then they're going to, they're obviously going to fractionalize it, and then we'll be using a Reg A sort of vehicle to be able to offer those assets as well to the general public.
So I want to get back to that later, but I'm going to jump over to Eitan right now and tell me why as a retail investor, why would I want to invest in an alternative asset that's not debt, it's not equity in an early stage firm? Is it just for the diversification? Why would I want to do this? I mean, sell me on this.
I'm not going to sell you on it, but I'll tell you kind of my perspective here. Look, the private markets are much bigger than the public markets. Historically, it's been very challenging for not yet accredited investors that represent roughly like 90% or so of the population to have access to participate in private securities offerings. Why should that only be limited to accredited investors? That is what these exemptions address first and foremost. Now, why someone would be interested in participating in a private securities offering, you have to also remember there's all different types of offerings, right? There's the traditional startup that now, rather than just accredited investors, anyone, their customers, fans, followers, the general public could choose to participate. If they like the terms, if they like the offering, if they feel comfortable, then they're able to participate. They're limited to how much they can participate to kind of protect them ultimately, but they're able to. Next, there's this idea of what we talked about, fractionalizing shares, right? It's taking that $10 million art piece that's going to trade once, twice a year or 5 years at Sotheby's, and saying, why should the little guy not be able to participate? Here's a way through these exemptions to fractionalize that $10 million piece into $100 shares. And now, not just accredited, anyone can participate. So now I've always been a fan of buying a Monet or a Picasso. Again, if I'm comfortable with the terms, I now have a path to do so. Third is funds, right? Let's say a bond issuer, a REIT, etc. Again, same idea. Credit investors historically have been able to participate. Now, the average American has a path through these exemptions to purchase exposure and shares to potentially yield generating investments on the debt side. So those are just kind of three different approaches of what an investor who, for the first time, probably ever in many cases, will be given an opportunity to consider and invest in these assets.
All right. Okay. So I'm not quite sold yet. I'm an investor. I want to make a return on my investment. And the only way you can make a return on the investment is to have an exit opportunity. If it's an early stage firm, typically, it's via an IPO or an acquisition. If it's, debt, well, the debt expires at some point in time. I buy, let's use the art thing, a share in the art. Abby, how do I get out? How do I make money out of this? Do I just get a digital image and I hang it on the wall and I'm like, cool, I can talk about it at the next, rager I go to? I mean, how do I make my money?
No, I mean, I think you're sort of spot on, right? Well, to sort of echo on one thing that Eitan said as well, and there's different types of yield, right, and different types of investment opportunities that come down when you're looking at alternative assets, and a majority of them are going to be issuing dividend yields or issuing different components. But is that a major exit? No, likely not. But one of the cool elements beyond it, when there's two different paths, right? One, obviously, if we're talking about the individual art piece that does get sold, multiple times throughout its lifetime, or, maybe one or two times over the course, they're generally having a little bit more of a shorter exit time frame than your traditional tech company. So you're not historically looking at, 20 to 30, 10 to 12 years to have an exit opportunity. You're looking, a little bit sooner. But one of the other elements, as you're slowly starting to see it, it's still not fully prevalent yet today, but eventually there's going to be a point in time where secondaries starts to play a bigger role in the space. And as the private markets do get substantially larger and larger, and then every year there's billions and billions of dollars that are being put into it. I think the perfect example right now is when you look at just secondaries as a whole, and the opportunity to buy stock in OpenAI, or the opportunity to buy stock in those private companies, is also attributed to either companies doing buybacks or the ability to sell. And then the third is the component of tokenization, right? If you do have, and you do end up tokenizing a component of these assets, you can list them on a secondary exchange after it's restricted, or after its lockup period has come to an end. And traditionally speaking, it's 12 months or less, and have the ability to transact and sell them as well. So there are buyers, there are liquidity pools, there are ways to get access to your capital returns. And in certain cases, even when you look at, different types of models and structures where you can even cash out through net asset value every 6 to 12 months and have that as an opportunity as well. And so I think there's a lot that is still transforming within the space. Alternative assets is a nice way to get in without putting, substantial capital up. Usually the minimum investment is substantially lower, but also learn about the space, learn about the industry, and have the ability to hit exit opportunities shorter than longer returns.
Okay, so Cedars, which is part of Republic, soon to be known as Republic Europe, I think that in Europe, it's been one of the most effective platforms to operate a secondary marketplace. And there's a lot of reasons for that, and we don't have to go into that right now. And I was actually looking at it today, and I see, I see, the notional values. I see that people are looking to sell some shares. Is that something that the Republic in the U.S. is going to replicate or leverage here? Is that what you're looking at? And would you do that for alts?
Yeah, it's definitely an area that we're looking deeply into. I think one of the bigger challenges so far on the U.S. side is that the market is not large enough to have both, buyers and sellers, and you really do need a strong curated marketplace to allow for secondary transactions to take place effectively. One of the challenges, and there have been platforms that have attempted to do this, but the reason they failed is because when one individual is selling 2 shares or 5 shares or 10 shares, it's not really enough to make a market happen. And so once there's volume, once there's the ability to do so, then you have that opportunity. So I think being very looking at it when it's more at time sensitive and understanding when the right opportunity is, as opposed to jumping into that space, is going to be critical. But it is an area that we're going to be tapping into. The one thing I'll add to that as well is the way that we're looking at it is two-sided, right? There's the traditional route where it's just equity or common stock, and you're in the form of non-tokenized. But the second format is tokenization and leveraging that through an exchange and having that ability to trade it, buy and sell through the blockchain. The hope in that route is that there is going to be a little bit more volume, given that the majority of shareholders that are holding it are seeking or looking for liquidity faster. I think the best example would be if you look at anything that's within the alt space, like real world assets, and have that ability of transacting on real world assets, which is a little bit more prominent than your traditional company on a secondaries at this early stage at this point in time.
Okay, so Mohit, I know that you have some experience in this space for creating liquidity. And correct me if I'm wrong, but I think you are actually working on a solution now, or you're thinking about it for the private securities markets in general. So how do we solve this issue? I buy an alternative asset and I want out.
Right. I think we talked about that briefly. I just want to throw a caveat to you, and I really apologize that I have about 5 to 7 minutes and I'll have to split, but these two gentlemen that are flanking you are more than capable of carrying this on for hours. But to your point, Andrew, I was a former equity trader for E-Trade Securities for several years. I headed one of their divisions, and in real estate, it's location. In trading markets, it's liquidity. And to the extent that secondary markets in the alt space, specifically ATSs, to the extent that they're able to at some point formulate a framework to be able to provide for that level of liquidity, where would it come from? It's certainly not going to come. It certainly operates as a bulletin board right now. And it's not going to come from buyers and sellers on the box when you see spreads of 200, 300, 400%. It's going to come from somebody making a market. And that is the difference. And in the market making capacities that are there for DTC participants in our senior exchanges allows for that liquidity and, creates an efficient marketplace, right? That's why we have that. So I think what we're going to hope to see here is some layer of that being able to be provided for in an ATS system, unless you have a critical mass of holders that are trading back and forth constantly and having the controls in place for that liquidity. You're really going to see some of that liquidity drying up, or just spikes and spurts of it, and really wide spreads. So at this point, the reason why a Masterworks type model works, or perhaps even a real estate type model works, or portfolio type models work or have been working, is because you have a company that holds assets and they're flipping their assets, which is driving yield for the holders, right? So the holders don't necessarily have to go into a marketplace or sell. That is essentially the exit, right? So if there's a company like Masterworks that is selling a piece of art every 6 months or a year because they're big buyers that want to buy that, the beneficiaries of that delta are going to be those holders that got in. So they're exiting out on a redemption, as opposed to exiting out in an ATS or elsewhere, or waiting for a company to go public, or another raise, or an up round, if you will. And that's why we're seeing velocity in that space.
So that's actually kind of interesting, because if you're talking about an example like Masterworks, that's probably a faster exit than early stage, because early stage can be
100%.
years and years and years and years, and maybe never,
100%.
right? But
I see that every day. I see that every day, logging in as an administrator, logging in and seeing the movement. As a transfer agent, we see that because we obviously have to reconcile. All of the balances and the shareholding. So whether the reconciliation is coming from their partner ATS, or it's coming from within their bulletin board system or marketplace, or a redemption for that matter, we're seeing that. So we're seeing a lot more velocity there. Versus your traditional sort of Reg A plus privates that are on the secondary trying to trade on an ATS or various other ATS that are API'd into. We're just not seeing those exits. So now it's a wait and hold period sometimes for some of these companies that are trying to get an up round or exit out to a senior exchange.
Okay, so now you're selling me a little bit on this because, early stage, it's not for the impatient. I can be pretty impatient, but I can see that where there's like a known piece
I'm not
of
selling you. I'm just trying to get on my flight.
Well, it's going to be
Stop
delayed.
kidding.
Don't worry
No,
about
I'm
it.
just joking. I'm just,
Especially if
yeah,
you're
I know.
flying American,
I
you're
got
going to be
it.
delayed till next day. But,
No, it's Delta. This lounge is awesome, by the way. But go ahead, Andrew. I didn't mean to cut you off.
Yeah. Just let us know when you're going to hop off. So I'm going to ask the same question to you, Tom, because we've talked about this numerous times in the past.
Yeah.
You have some interesting perspectives on it, but I think we all recognize that liquidity for private securities in general is a challenge. And I'm wondering if it's the same challenge for alts like art, or maybe it's better, maybe it's worse, maybe it just depends on the asset. But how do we fix this, Tom? What is the solution to the enigma?
First, you have to understand the different categories involved in this process that need to be fixed. So first, if you're raising money through a Reg CF, let's say you raise $2 million and you're a startup, I wouldn't, as an investor, I wouldn't expect any liquidity there. You're basically getting early access to hopefully something that might work down the road. And for those $2 million of securities that are sold, it's not like there's going to be this like marketplace with market makers and like a tight bid and ask. It's just not going to exist. Now, there will be, if the issuer opts into a secondary relationship with an ATS, there will be a path to potential liquidity, which is interesting in and of itself. It doesn't mean that you should expect there to be a strong bid to come take your position out, at least not until there's better news and something happens down the road. So that's the startup, and that can apply for Reg A, Reg D, Reg CF, et cetera. Then there's the fractional, there's the fractional marketplaces, and there's the specific assets that are being fractionalized. That, to me, does represent a real path towards real liquidity, but only once there's market makers involved, only once there is a tighter bid and ask, ultimately. Because if you're just going to open up the ability for your existing shareholders to trade, to buy and sell, you're going to be limited as far as the activity done on the secondary. The real answer here involves ultimately structuring the right offerings and making them sizable enough to warrant the inclusion of a market maker, which will then potentially open up the interest and the accessibility of RIAs and managed capital to participate in the purchase of those private alts, because there's a path out, right? And that hasn't really happened yet. And once that does happen, then you have some of the online brokerage firms that are out there that have the fancy apps, I won't mention any names, that traditionally have been offering their investor base not only access to public securities, but also crypto. Crypto is not necessarily as in favor as it was at that point. So they're looking to provide private alternative investment opportunities to their base. Their challenge, we need liquidity. We don't want to just open up our 30 million accounts to be able to buy these private alts and sit and wait. These platforms, and ultimately RIAs rely on, these things actually potentially working out. There being a path out, just like there was a path in. So again, this is a work in process right now. And we're seeing it evolve, I think, in three main areas: music royalties, art, and real estate. I believe are going to be amongst the first to get to that level. But again, it is still early days. But it is important to recognize the different types of issuers, securities, the size of the offering, and then the expectations as to, is liquidity even a thing for some of them? All right, so that's really.
Yeah. I love the idea of having a market maker. I think that that solves a lot of problems. We're not there yet, but Avi, I'm curious, have you guys discussed that? A market maker, is it something that's even on your radar, or is it just too far out?
Yeah, I think it's a little far out right now. I mean, I similar to what Eitan was saying, is it's going to take a little bit of time to get there, right? A lot of these companies, especially given their stage and how early they are today, when they are going down the path, let's say leveraging Reg CF or, leveraging any of the other security exemptions that are out there, there's not enough, investors, shareholders, individuals that currently buy and hold the stock on a regular basis to have, a seamless opportunity to go down a liquidity pool, right? When you're talking about the tech stack and just looking solely at that space. Now, I hate to use this example, but when you theoretically look at how the blockchain industry changed back in 2020 and 2019 and 2021 with the issuance of NFTs and other areas, right? There was a massive market and interest for, secondary sales and tertiary sales and multiple transactions take place because of the finite number of, pieces available or the finite resources, but also because, there were several people promoting it and marketing it. And I think in order to really have this whole establishment of there's a market maker, it has to be very seamless and very easy for investors to understand, one, but two, also for them to have both a place for buyers and sellers, for it's very easy where valuation is not fluctuating substantially from a private enterprise or a private company to what it is going to be sold for on a public market or a secondary exchange. And there has to be a lot more that's done in the space before we can get there. But then, even then, I think that certain companies itself are not meant to market or transact on secondaries yet, right? If you're a seed stage or a Series A stage company that's just starting off and you're getting off the ground, to have a secondary transaction, it probably is a little too early for that to take place. Versus, as you're more mature and as the team is looking to buy back equity, or you're thinking about a public listing, or you're having that opportunity, that's when there's a lot more demand and there's people that are actually excited and eager to purchase that set stock. So, in short, is that a route that we're looking at? Of course, everything is we're always monitoring very closely where things are within the space. Is that a top area of focus today? Probably not.
Yeah, okay, that makes sense. And it's interesting. You bring up NFTs, and NFTs like went like this, and then they kind of went like this, and now there's I don't know where they are. And then there's this whole debate about whether an NFT is a security or not, depending on who you speak to. That was kind of interesting. But the one thing you did see was a lot of trading activity, at least at one point. I think it's dropped quite a bit since then.
Yeah, exactly. And that was because of the hype, right? Like there was
the hype cycle.
So much excitement. There was, there was a point in time when NFT first came out where, you had Bored Apes that were trading north of a couple $100,000 for one, and today they're substantially lower. But it's because it's
substantially
someone is willing to pay at that specific time, right? I always tell startup founders itself is when they're thinking about valuation today, right? Whether you're raising via SAFE or you're raising via equity in itself, it's at the end of the day, especially when you're doing a CF or any of those types of raises in itself, you're generally raising very closely from friends and family as well as customers with it. So when you think about valuation, whatever you put out to market right now, that's not really going to be your final valuation when it's all said and done. So if you do list on secondaries, if you're going to have an immediate short sell where if you price yourself substantially higher, it's just going to devalue the company long term. So you have to be very considerate and hyper focused on the timing to allow for secondary transactions to take place, and ensure that your business is at a point where it's stable enough that the price is not fluctuating substantially when it comes to private exchanges with the small blocks of transactions that are taking place.
Yeah. So, okay. You mentioned RWAs, real world assets, and the tokenization of real world assets. And actually, I think this has a lot of potential. I have been wrong in the past. I could be wrong again. But I think that the process of turning something into a digital security, which is easier to manage going forward, that has a potential, not just for alts, but alts are awesome, but everything else. I'm going to ask Eitan first, your opinion on this. Do you think this is a path forward? And then I'm going to jump back to you, Avi, and ask you the same question.
I think it has potential, but I think it's more of a distraction currently. For example, let's say you have a $10 million piece of art and you want to issue that security through Reg A. As an issuer, you're able to determine the price per share. So you're able to fractionalize that, not necessarily tokenize it. You're able to utilize technology and the exemption to offer shares of that security in whatever structure and price per share that you want. That achieves a very similar objective to this idea of tokenizing it, because it puts it into smaller increments and it allows more people to participate. And you're also able to, through the inclusion of an ATS, facilitate secondary trading. I think now, the idea of tokenization could be a distraction, because what does it accomplish in a different format than what I just described? And the idea of blockchain inclusion also is currently, I think, a distraction as well, because to transact in U.S. securities or to issue U.S. securities, you need an SEC-approved transfer agent. Ultimately, you can, and they keep the cap table. Ultimately, they're the ones that are responsible for keeping the cap table, not what appears in the blockchain. You could utilize the blockchain to mirror the SEC transfer agent and the cap table, if you like, and you could tokenize the securities and you could have them listed on that blockchain. But ultimately, when you strip away everything, it really is, you need to issue through in a legal and a compliant way, and you need to have an SEC transfer agent involved. You need to have a SEC approved alternative trading system involved to facilitate secondary. So I think there's a lot of confusion, but I think ultimately, with cross-jurisdictional advantages on a more global scale, which is going to take some time, if and when it happens, then you can make the argument to unlock the value, not necessarily of tokenization, but of the inclusion of blockchain, so that everyone's looking at the same thing and could participate in those opportunities wherever they are around the world. But until then, again, we focus on, from an investor's perspective, they're buying a security that has to be done in the compliant, straightforward manner, right? Just like they're buying a share of stock elsewhere. There's a transfer agent, there's a brokerage statement. And so again, I think these things could be distractions currently.
Okay, so Avi, do you agree? Maybe you agree with all, some, what? Tell me.
Yeah, no, I definitely agree with certain points there, right? I think the one point that I will add, I don't think blockchain is meant for every company, right? Or meant for every, asset class or every element attached to it, right? I think there's certain industries where it works better than others, and certain industries that it's just not there, right? Like in 2021, it was a massive buzzword. So everyone threw blockchain into it, just like how everyone is mentioning the usage of AI today. Now, does that mean they have an idea of exactly how they're implementing it, or is it for the right use cases? Probably not everybody, right? And so I think the understanding of how you can implement it and use it for the right purposes, intentions are there. The one thing that we always say here is let's use the example of a security token, right? And a security token in itself is just a wrapper around equity, right? It should be treated as equity. It is equity. It's that in the case of future, where if you ever choose to or you want to, you can feasibly tokenize this, this security, therefore to allow secondary trade. Now, does that mean today you should go about doing it? Probably doesn't make sense, but maybe this is something in the future. The one element where I actually do love tokenization, and I think that it does play a pretty strong, aspect, is let's use the example of real estate as an asset class today, right? Where when you have an investor that's investing maybe, $500 into a multi-unit or a large multi-family estate property or an apartment building and so on, and said investor is going to get 8% in preferred dividends on a biannual or annual basis. The benefit behind leveraging blockchain at that time, or maybe a security token in itself during that element, is the fees of issuing dividends or transactions at a quick and easy and convenience, as well as a low cost method, right? Versus if I had to issue, a $40 dividend at 8%, or, let's say biannual $20 each time, it's going to cost me $15 to send a wire or an ACH. And so leveraging that use case and leveraging it for the fractionalization and small dividend payments and transactions can be quite easy, and also just depository into a wallet, right? Like again, right, if it's very similar to any public company that's issuing dividends today, when they're issuing a dividends through a brokerage, it's very nice and simple. It's because it just populates directly in your wallet and you have the ability to reinvest. But if I had to get a cash check or something that was ACH and sent out to me, for the person that's issuing those dividends, it becomes more expensive and costly. So it's really understanding what the right use cases are and versus not. But yeah, I mean, that's the short end of it from my perspective.
Yeah, no, I think that the best use case for blockchain, distributed ledger technology, or whatever you want to call it, is back office. It's not sexy at all, but anytime you can remove intrinsic friction to the process and stop the shuffling of papers back and forth into different rooms, that's a good thing. And when you start to scale, then you can start to say, well, penny here, penny there. It starts to add up over time if you can get everything to scale. Eitan, do we need to have? You mentioned this before about brokerages, I believe. Is that where we get the scaling and all this, where we have the eToros, the Robinhoods of the world that are not just doing crypto, but they're doing alternative assets too?
Yeah, that's one major way. That's major potential opportunity. That's super exciting. And once it gets properly figured out and structured, because you get to then leverage their tens of millions of potential investors on their platform rather than going to have to build your own audience and distribution channels yourself. So that's massive potential. Just to address two things, Abi, that you had mentioned. Tokenization helps for secondary. I think technology has already caught up today, and we have many examples of issuers that are active with secondary trading without tokenizing their securities, right? So you don't need to tokenize to list on. You need to tokenize to list on certain ATSs that perhaps are only approved in their membership agreement to facilitate secondary through tokenization. And many companies have taken the bet on the potential value and benefits of tokenization on blockchain.
Yeah.
And many have died on the vine over the last few years. That's hoping for regulatory change that might or might not happen, right? So it's important to understand that you don't need the tokenization necessarily to facilitate secondary. And the other point is, from a technology perspective, a lot of this, this ability to administer dividends, to make payments, this is all already in place. Technology has caught up, automation, machine learning, AI, whatever you want, to facilitate an orderly, cost-effective, frictionless method of distributing dividends to issuers based on how many shares they have, because there's real-time cap table management, there's automation to all of this. So again, it's already there. And so, and that is important to understand that, because again, we're focused on is what's compliant and working today, not as much in where we're betting the future might go. And not to say that there's anything wrong with tokenization. I just personally haven't really seen the real benefits in this current environment. I do believe that in the future, if and when certain things change, that it could evolve. And there is a pretty efficient mechanism of tokenizing your existing securities rather than trying to sell tokens as part of an IPO, right? That is something that's more traditionally done. It's just that there's not a real defined, from my perspective, reason to do so at this point.
No, I think you're right on a lot of points there as well, right? Like I sort of go back down to the main point at hand here is, it's only done, like it should only be done if one, the company knows exactly what they're doing, they know the component of it, or for some reason they have there's a value that they want to add to it. But I don't think, and I totally agree, I don't think it should be done for every company. And I think the way that technology evolves is everything catches up very quickly, especially nowadays. And the biggest element is, when and if regulations do come into place are so crucial, right? It's something that's been talked about for several years, but everyone knows it's still very slow when it comes to the blockchain and the crypto space as a whole. So until that really does come in, regulations are definitely a positive thing, but how long does it take to get there? When and if we get there, how is the technology formed at that time? What's the differences? Are all critical factors, and I totally agree with your points as well.
Yeah, and I hear you on that. And the regulatory environment in the United States continues to be opaque. And in Europe, it's a little bit more interesting right now because MiCA has just come into effect just the past week, which creates a regulatory ecosystem for non-securities digital assets, including stablecoins. And so that's kind of a big step. I don't know if it's the right one. It's a big step, but simultaneously, the European Securities and Markets Authority is doing a consultation on digital securities. And I think in a way that may even be more important. And I wish there was a broader discussion on that in the United States, where you could actually have the SEC and some of the other regulatory entities discussing how we can incorporate technology, better technology, into the ecosystem. But it's not today. It could be coming down the road. Again, I think anytime you can remove friction and make it easier to do a fractionalized asset or do a novel security, that's good. That's good. You know, providing opportunity for issuers and investors, and so we should be supporting that. And I have a lot of opinions on this, but I know people don't want to hear from me. They want to hear from you guys, because you guys actually know what you're talking about. But I want to talk a little bit about specific assets, because, you know, this is all kind of esoteric and it's ephemeral. It's out there. You know, we're talking about alternative assets, but both of you are doing some really cool things right now, you know, unique offerings, and you're doing different ones. And I'm going to start with you, Abby, because, you know, we were recently talking about Watford FC. This is a football club based in the UK. It's Premier League, or was Premier League or relegated, whatever. I don't know. You're selling shares both in the US and the UK. I think this is really interesting. So how does this come about? How is it going? You know, how are investors responding to what is really, it's not an early stage firm, it's not real estate. You're basically, you know, shares in a football team. How's that going?
Yeah, it's going well. I think it's you know, one of the elements that we've always found quite interesting here in the States, that has not really been done here, but it's been a little bit more common in the UK and the EU side, is allowing fans to invest in teams. So like Germany, for example, has a rule where it's 50+1. So 50% has to be owned by fans, and the other 50% can be owned by a majority shareholder and have voting rights. And I think that's, you know, when you're sort of going back to the main topic had, like alternative investments, a lot of it also does come back from passion, right? And the excitement about what you're working into or investing into, right? When you talk about different asset classes, and I'll stick on sports for the second, but, you know, it's, if you're looking at the opportunity and saying, hey, like, I'm in New York, and if I had a chance to invest in the New York Yankees, right? I think, you know, regardless of valuation or size, I'd probably put a couple $1,000s in there just to go around and tell my friends that I'm a part owner of the Yankees. And so I think a lot of it's attributed to not only bragging rights and the excitement there, but the ability. When you're looking at soccer teams as a whole, or, you know, football, when you're talking on a global scale, one of the elements is they still are treated as, you know, investments, right? You do have the ability to see returns. You do have the ability to seek acquisitions and exits, and they all do take place. So, you know, for example, if a team's in the Premier League that gets promoted into the Champions League, or Champions League to Premier League, right, their valuation generally does double, and has that growth and the ability there. So the way that we've seen it is, it's kind of exciting to allow fans to participate in sports asset classes, and hopefully there's a lot more to come on that side. And it's the truest form of, you know, fan ownership or fan engagement in that format, right? When there's another group here in the United States called Blue Owl Capital, Blue Owl, you know, and they're backed by Dial Capital. They have this fund called the Home Court Fund, and they're the only private equity group that has an exclusive relationship with the NBA that allows individuals, still have to be a qualified purchaser, but still at an individual level, can buy ownership into multiple teams at once through their fund. And I think it's exciting to see that, you know, having that opportunity open up and having leagues open it up to, you know, sovereign wealth funds or different groups. Why not give that same access to retail investors? Because what they're going to ultimately do is they're going to spend more money with the clubs. They're going to do different, you know, attributes. They're going to attend more games and so on. The last example I'll use is just look at the Green Bay Packers in itself, right? When they did their fan raise back through Reg A, what is it, about 4 or 5 years ago at this point, you know, you can't buy season tickets to them. Like their requirement for their fan raise was that you have to purchase X amount of tickets, but also, purchase X amount of shares, but you also have to buy season passes. So you can make it, you know, a restriction where now the Packers are sold out for almost 30, 35 years for tickets, season tickets. So it's the excitement and the fan engagement, but also the value add that can increase, with it, and sort of quote unquote the sexy side of investing when you get a chance to back something that you're really, really passionate and you love investing in.
Yeah, it's a great example of the new world of alternative assets. I want to ask you about one other before I give Eitan a chance to talk about all the cool things he's doing. Republic Note. Now, this has been an uphill battle for you guys. I've read some of the filings that you've done, even though they're kind of tedious to get through. But it's effectively a security that is based on revenue share for issuers that have exited, and you're going to correct me if I get any of this wrong, so thank you in advance. But basically, when you have an exit, a portion of that money goes into this fund, and then when you hit a certain level, that's distributed to all the note holders, and it is a digital security, right? God only knows how you got it through the SEC, but how is that going? Share some of your perspective on that. That was really interesting, by the way.
Yeah, and sort of going back to your point, Andrew, right? It's a lot of it's tied to innovation, right? And having the ability to participate in giving individuals a chance to solely purchase, part of. I like to say in very simplicity, like an ETF type scenario, right, where you're giving individuals a chance to purchase into large groups of stocks and so on, private asset classes. But to give it into perspective on how the note itself works, and today is Republic, when we are, let's use the example of a CF or a Reg CF raise that does take place, we take a small component of securities percentage in addition to the cash fee that does take place for each raise. Those securities then get pooled, collectively. So let's say, for example, a company's raising $1 million. They end up raising $1 million. We'll take, X percentage in cash, and then we'll take, 1 to 2% in the form of securities, right? That's not of your total company, but of what you raised on the platform. And that 10 to 20,000 ultimately accumulates into a pretty large pool, right? When you look at the 700, 800 to 1,000 companies that have raised on the U.S. side, and all of those 100% of the profits are then, redistributed back into the note pool. So everything that we profit from those securities is issued back into the note pool. And then once it hits $2 million, dividends are paid out to every note holder, pari passu to what you hold in your value. The additional element behind that is you have 25% of what our profits are from our traditional investment side that also get pulled into the note pool, and then that also gets distributed. The long-term goal has always been, and the vision is, we'd love to include every single asset class that's involved in Republic. So every part of Republic does go in, any sort of profit element that does get distributed goes into the note and has the ability to sort of get there. I think it's exciting, right? It's innovative, it's new. It's still in its early days. We definitely learned a substantial amount, and it wasn't easy, getting through the legal setup, the infrastructure, making sure everything was compliant. But it was the biggest and the most important thing, and it took probably a lot longer than we anticipated. But with the launch of it, it's quite exciting, and to see people are talking about it and curious and want to learn more. It's always nice to hear that.
No, I think it's awesome. I think it's nobody else. You're right. No, I have never seen anybody else do something like this. Could be wrong, but it really gives people an opportunity to participate in the successful offerings on Republic, and it's really kind of a pioneering type fund, I guess. There's a couple other offerings I want to also, if we have time, we'll get back to you about, but I want to jump over to Eitan because I can't count the number of issuers you've enabled that have done interesting, things. And I don't know if they're all successful or not, but race horses, you're doing that, or you're empowering an issuer to do that. You're doing SongVest. I think you're doing SongVest. Is that you, Eitan? You're doing other collectibles. Share with me some of the unique issuers that you are working with today, Eitan, and what that opportunity proposition is for investors.
So first on our site, we list many of the issuers and fractional platforms that we're working with on our site. We have that, and that number has grown significantly. Where I think we're working with the majority of those types of platforms that are currently utilizing these exemptions. Our model really is to power the platform rather than to be the platform, and that allows for other platforms to kind of grow and develop their own brands. But there's a lot of examples. There's for the fractional shares of horses. So we have two different clients, both in the fractional horse space. So far, each one has IPO'd a horse, which they fractionalized, and hundreds of people were able to participate in that. And both platforms, each won a Kentucky Derby. One this past year, one I think in 2020 or 21. That's a pretty fun, cool story, and it's an example of the power of allowing everyday Americans to participate in things that they're fans for and they appreciate, and so that there's obviously clients of ours that have done the art and baseball cards and collectibles and all these different types. There's also single family home issuers. In other words, I want exposure to rental revenue. I could either go and buy single family homes and manage them and take on risk and burden that's associated with managing a portfolio and building one. Now you have an opportunity to simply invest in another issuer who is doing that for you. And you could pick and choose which homes you want to buy $100 shares in, and hopefully they succeed and you get a pass through of the rental revenue or vacation revenue. So that's an example of being able of the everyday American be able to access a platform of all these different homes in different locations and saying, I want to buy all the ones in New York or the ones in New Jersey, or I want to diversify. So it puts more of the power and decisioning into the hands of the investor. There's also bond issuers. And there's also, we talked about athletes before. There are clients of ours that are currently, without mentioning names, there's clients of ours that are fractionalizing shares in individual athletes, right? That's pretty cool. I always thought, you're selling the potential future revenue, a portion of the potential revenue. I'm a new baseball player. I'm a new basketball player. I've done really well in college, and the future is looking bright. This is a way for the athlete to take some chips off the table, right? By allowing their fans to participate in their potential future earnings. Makes sense. And I think we're going to see a lot more of that. And you see that a lot in the non-securities related platforms with, that are not, with people being able to build their own teams and have interests in different athletes for, not necessarily for economic outcomes with every platform. But here's these are live examples of me being able to buy a share in a baseball player or a football player or a soccer player, not just the team, but the individual players. So you could build your own portfolio in that way. And I think this is just the beginning of that.
How do I get my return?
They have an LLC. They have an LLC that represents their future earnings, whether that's through the sport that they're playing or whether that's through licensing deals, et cetera, right? So there's that agreement. So all those revenues flow into an LLC, which is the kind of the issuing entity, right? That represents that athlete or that entertainer per se. Right. So just like their manager gets X percentage and their agent gets X percentage, and maybe whoever else invested on an institutional basis is able to get X percentage of the potential revenues that flow into that LLC. Now, so too, through these exemptions, can the little guy, the fan, could also be a beneficiary in that potential revenue. Right. They could lose everything if the guy gets injured or and many people will lose everything in a lot of these offerings. But they also can participate in fans that they choose, that they believe in, just like they could buy music royalties in songs and artists that they believe in and they like, right? That is really cool. And that's what's going on right now.
Yeah, now that I'm thinking about it, this is something that's been dabbled in the past by, traditional, asset management firms like Bowie bonds or, music portfolios. It's just, you guys are taking it to the next level. You're taking it to the next level. You're enabling, far more issuers to participate in this, and also allowing more smaller investors to participate in this, which I think is really cool. So we're not quite there yet. What's the secret sauce to getting us there? Where this is kind of an everyday consideration besides buying Apple and, Microsoft and NVIDIA. Avi,
Yeah.
what do you think? What's the short answer to getting there?
I still think education is super key, right? I think there needs to be a lot that's going out to the market, educating about, hey, how does it work? How do investors get access to it? What do the return profiles look like? What the ability is really, really important. And then I think it's time, right? I think it's as you start having more of these individuals that are starting to take risks and sort of put themselves out there, and as well as more on the space of trying new things and new elements, you're going to start seeing more exposure into the space, and that's when it's just going to fully evolve. So ultimately speaking, I really do think that, given that the industry itself is still very new, it's still very evolving, and when you sort of look at it in itself, it's like the example again, like with like Robinhood, right? When Robinhood first came out, and it was set to market, people thought the idea was crazy of offering commission-free trading. And now every platform that you go to is pretty much, for the most part, commission-free trading or as low as cost as possible. And so, with the adoption and the amount of users and individuals that are stepping into the space, I think that you're going to start seeing, people that are doing it right, and they're doing it the right way, and they're educating, and exits are happening, and people are seeing returns eventually as we're approaching like year 6 to year 8 in the Reg CF space, but also just allowing since the Jobs Act has passed. And once that you fully hit more momentum, it's going to be a huge factor, and there's going to be a lot more activity within that side of the business, and different asset classes and different pieces for people to look at and learn about.
That's really helpful. Eitan, how do we get there? Is it working with big brokers? Is it just more education, better awareness?
Distribution doesn't really exist yet for many of these exemptions in a significant way. It is very hard to build a community and very expensive to build a community. So you're going to see a lot of people make, attempt to come up with really, to initiate really interesting platforms. But good luck building that community to a point where you could rely on enough of your investors to participate in your offerings and deal with all the expenses of compliance and technology and regulatory and sales that goes into it. So it's not an easy task to just set up a great idea and for it to take off. And ultimately, I think there's going to be consolidation. And I'm a big believer in specialization, because I think the whole allure of all these things wears off quick when people make their 3rd and 4th investment and are sitting on it for years with limited communication sometimes from the entities that they've invested in. It's cool in the beginning, but then just like with Bored Apes and things like that, people aren't going to be stupid for so long. It needs to make sense ultimately. And so I think there's room for specialization in the area so that the platform itself develops a reputation for delivering quality to investors, quality from a investment perspective that pays off over time, hopefully, quality from a technology and consistency, quality from a communication perspective. These are all these factors that go in that most in the traditional investment banking world, you're not even thinking about, because this operates and looks and feels from an investor's perspective with these low investment amounts a little bit more like e-commerce than it does traditional banking, which means that you need effective marketing and promotion, you need automation, you need funnel management, right? You need because you're selling sometimes $100 or $1,000 investment increments, and therefore you need tens of thousands sometimes or thousands of investors to participate. That's very different than building out distribution or selling $25,000 or $100,000 investments. It's a whole nother world. And so I think it's hard to build community, but there's also tremendous opportunity if you could figure out how to show up with community. And that theoretically could lower your cost of having to go and market to attract people to join your platform, which is amongst the most challenging things I think to do in this environment where there's so much noise. Every time you're on your iPhone, you're being distracted by a million things. And to get me to go and join a new platform and to go and give my social and to upload my payment information and to sign a subscription agreement in whatever technology format you're asking me to do so, there's plenty of opportunities to bail and bounce. And so the key is, how do you tighten up that process so that the investor is getting value has an efficient, frictionless way to participate and has excellent ongoing communication and reporting, so that they're encouraged to use that platform again to add to their assets. So it's really just intelligence I think that ultimately is going to win here and is going to go into it. And also consolidation in some cases. If I'm just selling sneakers, I need to be selling a lot of sneakers and sourcing a lot of sneakers, and they need to be good deals. But if I'm selling sneakers and I'm selling other things that are related to sneakers per se, to that same audience, and I'm delivering them value, then there's more to shop. There's more opportunities to participate in without necessarily having to go and pay for and find, new investors to participate in that. So it's a balance, right? But and these are some of the things that we're experiencing that make it challenging, but also create opportunity.
Yeah, no, I agree with both of you. I think you're making excellent points across the board. I also think that you need to have a regulatory environment that's more conducive to innovation in assets, RWAs, tokenized assets, just, alts in general. And I don't really think that we're going to get there unless there's some change within, certain aspects of the government. Somebody mentioned up in the chat, HR 2799. That's actually good legislation that passed through the House, but it's sitting in the Senate Banking Committee where it's going to go there to die because the person that runs that committee doesn't want to have anything to do with it. So that creates kind of a wall that can be insurmountable. So that's part of the equation too. We're running out of time here very quickly. I want to ask a couple questions. There's somebody that asked about commodities. You could do, commodity sales. And I think there's some people that are doing that, but I'm like, yeah, why not? Are either of you guys, working with, commodities as an alt investment?
We're working with issuers who are in the commodities business that are utilizing different structures to get exposure to some of the underlying commodities, not necessarily, fractionalizing actual commodities per se. But again, like, we welcome innovation as long as it is compliant. Securities Council signs off, our compliance team signs off. There's plenty of different structures and possibilities that one could consider if they wanted to, offer commodities, to the public in that way.
One more question, then we gotta go here. We talked about market makers. It's an idea, a concept that I like. You guys both addressed it, but nobody said who would these market makers be. And I guess from my point of view, it would have to be, a platform. It'd have to be a feature of the platform. I don't know if, Avi, you have any thoughts on that? Who would end up being a market maker?
Yeah, I mean, I don't know if it would be a component of the platform or it would be more of a larger financial institution that is sort of backstopping and serving as a component of the market makers, at least until there is a large enough user base and an audience that could allow for it to take place, and obviously enough volume. But the amount of capital needed to be a full market maker is obviously substantially higher, and ensuring that you're not commingling with assets, you're not commingling with anything is important. So I would say it's probably would be more of like a larger, either brokerage or a larger bank that's sort of serving and helping supporting as a market maker on that side.
Hey, Tom, you want to add anything to that?
Yeah, it's the traditional bigger market makers that are currently out there right now that who we're speaking with and what we're talking about. They make money by making markets, but they need a compelling reason to make markets. And so both those things have to meet: the right structure, a sizable enough opportunity, a good enough track record for the issuers of those securities, and a market maker that sees the opportunity, and size to warrant their involvement. Once those things occur, and I believe they absolutely will at some point, hopefully sooner than later, then you're going to have potential. Liquidity is going to change definition. It's not going to be necessarily a path to liquidity. With active market making, it could become a lot more than that. And I think that's ultimately what's going to give comfort to managed capital considering allocations to private securities, because it's not this. What do? We wait for 7 years and hopefully they communicate with us or IPO. It's like, no, there's actually, here's the NAV, here's the bid and ask. here's yesterday's trading volume, right? And if there's no reason why that can't happen. It's just a matter of structure and size and the right issuers. And then I believe we'll get there.
It's a matter of time. I mean, you can see it, but it's still a ways off. Somebody asked about, where they should go to learn more about these. I would say that, go to Dalmore Group's website. They have a full stack of companies that they're working with, and you can click through and see what's going on with these companies, and they're doing some really interesting things. And then you have, Republic, which is now, the largest, global securities crowdfunding platform in the world. I expect, I'm sure Abby doesn't want to talk about it, but I expect we're going to see more unique and novel assets coming from the Republic platform globally. So there's a good opportunity to learn about things and then make your own decisions about how you want to invest your money. We are out of time. I want to thank both Eitan and Abby for joining us once again and sharing all your knowledge and wisdom. You guys are awesome. I really appreciate your information on this. I find it super interesting, and I want to thank everybody who's participated or watched this webinar today. And please visit Crowdfund Insider and join us for our next webinar once we get it posted. So everybody, thank you very much.